It's very important that they begin moving. They've taken a long time to get there. The Fed took probably longer than it should have, and I pretty much admitted that. They started moving in March. The ECB's got to start moving now. Exactly as Steve was saying before, inflation is very high. It has the potential to become entrenched unless they move, and they move aggressively. We'll talk about what aggressive means, and make it clear that they are going to be moving further. They run the risk of inflation becoming entrenched, inflation expectation becoming anchored, and having to raise rates much higher than they otherwise would have to.
Well, let's run with that, since Steve's getting very excited that you've picked up his comments around aggressive. In what world is a hike of 25 or 50 basis points from a negative 50 aggressive?
So I think they need to be much more aggressive than they have been. At least they're starting to move. So they're moving in the right direction. They're talking about moving in the right direction. So that should also help expectations. To defend them a little bit, the concern that they have is that there's so many negative shocks coming from the war, sanctions, uncertainty, that the economy is going to slow down even without raising rates, so that the inflation pressures are going to come off. But there is sufficient inflation pressure, there's sufficient risk of inflation expectations becoming anchored, that they really need to get moving.
And Randy, it's Karen jumping in. Good morning to you. What has been aggressive has been the markets. If you look at the repricing around the short-end German Bund, the 2-year, you've seen a 200 basis point move alone this year, taking us to almost, 2.8%. What's the market's role here in terms of acting for the central bank, acting for the ECB?
Exactly, because by talking tough or talking tougher than they had been before, the market's already starting to move to tighten financial conditions, credit growth slowing, which is exactly what you need in order to try to bring down the price pressures. But still, there's still a lot of price pressure that's there. So by talking about what they're going to do, even if it's not moving really, really far, that's helping to bring that up forward and to tighten financial conditions even beyond 25 basis point hike that they're probably going to do today.
Randy, as you know, there's a big debate happening as to whether the political backdrop is a supportive one for tighter monetary policy at this point. We're seeing that expressed through the United States, Biden making comments suggesting he will back up the Fed here. But there are questions as to whether he will be at the White House if some of the tougher policy is needed down the track, but also just whether that support will be tolerated by voters down the track with much higher rates potentially and unemployment. Same story in Europe, as you hear policymakers talk about working in concert with monetary policy on the fiscal side. But what do you make of whether you think the politics are supportive, but also whether some of the fiscal interventions we're seeing to try and offset some of the inflation issues this time around are sort of undermining the monetary tightening?
Yeah, so at least in the US, and I think also throughout the Eurozone, as well as in the UK, high inflation is something that voters really, really dislike. Of course, they don't like high unemployment, but right now the unemployment rates are relatively low in the US, Eurozone, and UK. And so this is the time for the central banks to be acting, because once the unemployment rate starts to go up, of course, there's going to be much more political pressure for them to move more slowly. So they have an opportunity. Inflation expectations haven't gotten completely out of control, and the political pressure will be coming, but it's not quite there yet. The pressure right now is more to bring down inflation, because voters are very upset about that. So I think it's important for them to move now. One of the challenges is that the tradition that central banks had of taking the punch bowl away when the party really gets going, they haven't been doing that for 2 or 3 decades. They've been there to provide support when the economy is going down. The idea that they could be raising rates to induce a slowdown and potentially even a recession to reduce inflation is something that just really hasn't happened. People have forgotten that that's one of the key roles that central banks need to have.